The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The weight of high expectations. Live from Studio 2 here at Bloomberg headquarters in New York. I'm Romaine Boston.
And I'm Scarlett Fu, and we're kicking you off to the closing bell here in the U.S. A down day for U.S. stocks. It's rare.
For a second straight day.
I know.
Yeah.
So let's take a look at where things stand right now. Lower stocks, also lower bonds as well. You do have the S&P 500 retreating from its record high on Monday. A bright spot within equities is the home builders, up by 0.75% after the new home sales number blew away economists' estimates. Yields are moving higher across the curve. The 5-year auction was fairly solid. Yields did spike on Oracle's $18 billion bond sale, but we saw yields come off their highs after issuance went through and it found eager buyers. We're also looking at the dollar higher by 0.5%. In fact, higher versus all 16 major currencies, Romaine.
Yeah, Scarlett, but you mentioned how this was kind of a rare down day for stocks. But you think about where we were this morning, it actually looked we were actually going to get a big boost from the AI trade after that surprisingly good guidance that we got from Micron last night, as well as comments from Alibaba on its $50+ billion commitment to become a full stack AI service provider. But alas, it's hard to really see how any upside right now in the AI spend hadn't already been priced into this market. So maybe that does explain the modest pullback that we're seeing today and yesterday. And maybe it also explains the muted price action that we've seen over the past 5 weeks. Keep an eye on that, because to be sure, despite the slump, there is still a tilt in market sentiment that is still firmly bullish. Short positions, they've been cut. High beta, unprofitable tech names, they're outperforming. Systematic strategies, they're maxed out. And options volume skewed toward chasing the upside. The selling of puts, a sign of greater risk-taking, that's reached, quote, eye-watering levels, according to Nomura strategist Charlie McElligott. Still, whatever warnings blare out there and whatever caution takes foot, all that is being drowned out by a bullish narrative reinforced by the lack of any foreseeable negative catalysts on the horizon. J.P. Morgan's global head of market intelligence, Andrew Tyler, quipping to Bloomberg a little bit earlier that in the conversations he had yesterday focused on what could derail this bullish run, his favorite response was an asteroid hitting the Earth.
In other words, nothing that he can see coming right now. And that bullish narrative is pretty firmly entrenched, judging by this chart. So the top panel is the S&P 500, and it's rock steady march higher since April when Trump announced his reciprocal tariffs. Now, the bottom panel is the index's drawdown from its record high. And since June, you could see that drawdown has been within 2.5%. That's the dotted yellow line there. Every single day since June, within 2.5%. Now, right now, the S&P 500 is about 0.9% shy of its all-time high. So, Romaine, if investors are looking to buy the dip and there's no dip to buy, then naturally you have a rally that kind of just runs out of steam.
Yeah, great point. As we kick you off to the close here on this Wednesday afternoon, Amy Wu Silverman joins us, equity derivative strategist over at RBC Capital Markets. And there's been a lot of talk over the last few days, Amy, about what the options market, what derivatives are saying about investment sentiment right now. What are you seeing?
Yeah, it's changed dramatically, Romaine. So pre the FOMC, we saw a lot of bearish sentiment. People had their hedges on. They were gearing up for this drawdown that has never come so far. And since then, the folks who knew that their puts had to roll off did not reinitiate them. We've seen, not only that record put selling you mentioned, but also record call buying. And you've really seen this inversion of sentiment where, again, we continue to talk about that left tail being relatively absent, returning to the chase of that right tail being something that investors are more worried about now.
Do you worry, though, about that skew? Does that become a concern?
Yeah, I was actually, to be honest, feeling better pre-FOMC because to some degree, if people are well positioned, then if you do get that drawdown, at least people can monetize it. So that's what we had April 2nd. In some ways, we're actually in more dangerous territory because if something does happen exogenously, no one is prepared this time. No one has that round on. And I think sometimes that's when you do get that volatility pothole. But, as you mentioned, what is that question mark exogenous shock? Hopefully not an asteroid hitting the Earth. But, I hope not too, fingers crossed. But, I think looking for that is why investors have started to roll off their hedges because they're not sure what that is. It certainly wasn't the Fed.
Yeah, they're kind of looking behind their shoulders there. Not counting today, Amy, we still have 4 more trading days to go in this third quarter. Will there be any meaningful quarter-end rebalancing taking place that, we need to be mindful of?
a lot of these quarter-end rebalancing, you also have tax loss harvesting, you have earnings kicking off, and then you actually, in a week, you have a debt ceiling, right? So there are things that I can think of. But when you look historically, it is no more than kind of the standard that you're pricing in compared to history. I would say, it's simply going to be a function of positioning, I think, because it comes down to if we do need to somehow chase because there was a drawdown, investors are not positioned for that. Similarly, when you had that spike up April 2nd to the upside, investors weren't positioned for it. That's when you get those exacerbating moves.
Speaking of debt ceiling, do you see any kind of positioning around that, or is it still too early? You have to wait until the day or two before the actual deadline for that to take place.
We have not seen anything so far, and I think in investors' minds, it's a little bit of a nothing burger because, to be fair, the previous historical debt ceilings were nothing burgers. The only exception is 2011, which I know that's going quite far back in time, but we actually did get a meaningful drawdown then for the debt ceiling, and you actually got a VIX spike nearly to 50.
So this gets to a question, and we start to get through these next couple of weeks. Obviously, get through the quarter-end rebalancing. Maybe we get past this debt ceiling, this government shutdown issue. That brings us back into earnings season. And I do wonder, Amy, when you look at some of the moves that we've seen in the market, particularly coming out of this summer, do you think that upside was driven more by technical factors or by some of the more fundamental and macro factors?
A little bit of both. I think, one thesis I've had remains since sort of post-COVID is that this kind of traditional fear of the left tail, which I think everyone is primed to believe, has actually been outweighed by the right tail because of this concentration risk, because Mag 7 plays such a big part in most of the indices that folks benchmark to. This chase of the right tail, if you get, you wake up one day and you get this massive move to Oracle, you get some announcement on OpenAI, investors have to fear that because they're going to be left behind just as much as they have to fear a drawdown on the other side. So I think what is happening right now is, again, you didn't get that buy the dip opportunity, right? So those folks who were perhaps waiting for it are saying to themselves, I only got X months until year end. What is it that I should do now so that I do not underperform?
What does it say, Amy, that you had Jay Powell yesterday observing that equity prices are, quote, fairly highly valued? And then you also had the president make references to the stock market at record highs in his UN speech, too. What does that say about the psychology of investors at this moment, that however strong the sentiment is, people saying it out loud was enough for people not to buy in right away?
Yeah, it's interesting. I have one anecdote to share with you, which is like whenever I'm speaking at a relatively large meeting, so, maybe 30 or more investors, everyone's going around, they're talking about their bearish sentiment. And then if I say, show of hands, who thinks the market is going to be higher by year end? Like 90% of folks raise their hand. So it's this reluctance in the rally for sure. But then again, there's this impulse to be very concerned about that right tail and feel like they still have to chase it because they know that they cannot be left behind.
Amy, always wonderful. Amy Wu Silverman, equity derivative strategist over at RBC Capital Markets, kicking us off to the close on another down day for markets, though the pullback is modest to be sure. When we come back, we got a lot to talk about. We're going to talk about the CFA. We're going to talk about the charter holders, and we're going to do that with the president and CEO of the CFA Institute, Margaret Franklin, her thoughts on how the analyst game itself is being redefined. And we're also going to hear from the CEO of Janus, Henderson. Ali Dibadj going to be joining us to walk us through his firm's growth story and what direction he expects the markets to take in the days ahead. And we talk money in motion. Hemant Taneja going to be joining us, CEO of venture capital juggernaut General Catalyst. He's got an AI trade, but it's actually not the one you think. Stick around. This is The Close on Bloomberg.
While the last round of CFA Level 2 testing saw its pass rate rise to 54% above the decade average, there are questions surrounding how many people are even attempting to take any level of that exam. The number of candidates has plunged in recent years from the peak in 2019 when the test saw more than 270,000 takers. Here now to discuss what this means for the future of the analyst industry is Margaret Franklin, President and CEO of the CFA Institute. Great to see you here.
Great to be here.
So I guess my first question to you is, we are in a moment where the most exciting companies are often not publicly traded. Right. They're privately held. They're in industries like crypto as well. How relevant is the CFA exam when that's the new frontier of investing?
Well, it actually remains still as essential as ever. And first of all, I think what people, particularly people who've taken it a while ago, may not recognize is how the curriculum keeps up with the capital markets. So in the last 2 years, we've introduced pathways. So at level 3, you can take much like an elective, traditional portfolio management, private markets, or private wealth. So it remains as relevant as ever. Valuation, risk management, ethics, portfolio construction are the foundation. The assets that we are using to do those things change, and the program keeps up with that. So
the new exam incorporates that, but those who have their CFAs already, maybe a decade ago or 2 decades ago, do they come back and also brush up on those skills? Yeah, they do. Our #1 publication is our refresher readings, and members have access to that. We also launched practical skills modules, so knowledge and skills, and it's taken up by our members just as well. So you may find that a professional throughout their life actually pivots in their career, or new asset classes are introduced. Tokenization, digitalization is, 10 years ago, that just wasn't a feature of the capital markets. And so in addition to the CFA program, we also have a portfolio of certificates. So if you're now looking at tokenization, or you really need to think about sustainability or private markets, we have certificates for that to give you the advanced training and knowledge that you need.
I am curious about how quickly you can update curriculums and really the mission as the financial industry evolves. I mean, obviously a few years ago, a lot of people were sort of turning their nose up at digital assets and crypto, and now it has become a major asset class. Similar story with a lot of what we saw in the alternative and private market space. How quickly, once you get a sense here that something is now really becoming meaningful for the industry, that you can pivot the curriculum? So
I think there are really 2 ways that we address that. First of all, within the CFA program, that's a foundational, generally speaking, earlier career course, very, very rigorous, high validation and assessment, which employers really value. And then we get to that more expanded portfolio. So it has a wider range. And then finally, we have our research advocacy and standards. And that work can be right at the vanguard. And capital market or asset classes are being formed, what are the considerations? What AI allows us to do is actually begin to coursify those things. So we will be able to provide our members and learners and those professionals a broader suite of ways to learn, engage, and apply techniques to new asset classes, and also to be able, of course, to consider the ethical application of it.
I'm glad you brought up ethics. Obviously, ethics is a huge pillar of the CFA program. And this might be a bit of a loaded question, but it seems that as of late, we live in somewhat unethical times, at least in certain pockets of our economy. And I'm speaking globally here. And I am curious as to how you maintain a standard, a high standard of ethics at a time where we do see a lot going on in financial markets that would be well below that standard.
So we have our code of standards, standards of practice and code of conduct, and members, charter holders, attest to that every year. What's really interesting about the community is they self-regulate. So most of our violations, like obviously we use detection techniques globally to surface where breaches are, but actually our member community is really vigilant on breaches, and so we actually have quite a robust process program around that, which often people don't know about.
You mentioned AI, and I'm curious about the role of AI in general, because someone could have an AI bot take the hardest CFA exam, that is level 3, right? And it can get it done pretty quickly. So that being the case, if you're an analyst, what's the point of getting a CFA credential, that certification, if the firm can get AI to do it even faster than that?
So I think this is I'm very glad you asked this. And in fact, actually, AI, we expect can pass our tests, and we expect like it can pass any test. But a test actually is not just can you achieve that moment. It is actually the foundational, fundamental assessment. Do you know this? Can you apply it? Can you contextualize it? So it's not just passing a test. AI can do that, but it's not accountable for the outcomes when they get out into the real world. And so, there's the knowledge, how we value things today. We may have different asset classes. So it assures an employer that the person who shows up actually can do what what we validate that they can do. Importantly, when you're trying to discern among talent, it's a shorthand way to say this is somebody who's disciplined, who can master, can get through it, grit and determination. And then finally, when we think about capital allocation, security decision-making, constructing portfolios, human in the loop is incredibly important. How you apply those things and knowing what needs to be asked and how to evaluate what comes out of AI is critically important. And that is where the human in the loop becomes really important. So in fact, actually, the charter program becomes more important because employers can say they know it and there's application to it. Then the question becomes, do you know what questions to ask? Can you evaluate what comes out? So we're going to see that, I think, in many, many instances, AI is not going to replace the human, it's going to augment it. And we can certainly see the application of AI to look at better data sets, process information more quickly, and answer questions we just couldn't have done before. So we expect outcomes to improve.
All right, Margaret, I got a lot more to talk about. We're up against the break here. Great conversation. Hope to have you back. Margaret Franklin is the president and CEO of the CFA Institute. Stick with us when we come back. Barclays talking about the beverage breakup that investors have so far panned. Keurig Dr. Pepper. We're going to talk to an analyst behind the latest downgrade on that stock when we come back after the break. This is The Close on Bloomberg. Time now for our top calls, the big movers on the back of analyst recommendations. And we start off with Amazon. Wells Fargo upgrading to overweight. The price target going up to 280. The analysts seeing Amazon Web Services revenue growing more than previously expected in 2026, helped partly by that partnership with Anthropic. Those shares down, for a third straight day. Next in line, let's take a look at ServiceNow. Morgan Stanley upgrading to overweight. The price target going up to $12.50 from roughly about $1,000 a share. The analyst over there, Keith Weiss, says that while uncertainties around federal government contracts are certainly understandable, investors, in his words, are missing the forest through the trees when it comes to ServiceNow's 2026 targets and free cash flow growth. Those shares getting a bid of about 1% on the day. And finally, let's take a look at Keurig Dr. Pepper. Barclays cutting to equal weight, taking the price target down to 26 from 39. The analyst over there, Lauren Lieberman, citing uncertainty surrounding the impending breakup of its businesses into two segments. Those shares down about 1% on the day, and they're down at least about 16% since that announcement back in late August. Those are some of our top calls, and we do want to stick with the last one because I'm pleased to say the analyst behind it joins us right now. Lauren Lieberman is the U.S. Cosmetics, Household and Personal Care and Beverages Analyst over at Barclays Equity Research. All right, I'm a little confused, Lauren. People didn't seem to like this company as a whole, but they don't necessarily seem to like it in this future breakup. Explain to me what's going on.
Sure. So the future breakup, the situation is Keurig Dr. Pepper, we'll call it legacy, or as it stands today, is the Keurig business in the U.S. So think the coffee pots and the pods. And then it's the legacy Dr. Pepper Snapple Group business. So Dr. Pepper, 7-Up, Snapple, and so on. People have been struggling, let's call it, with this business because the coffee business had a great big surge during the pandemic and then never really recovered, I think is the easiest way and simplest way to put it. But it was a really well-owned name. A lot of people own the stock because there seemed to be good visibility this year and next into high single-digit earnings growth. They have a strategy of bringing in partner brands through their distribution and route to market for soft drinks in the U.S. And valuation wasn't terribly challenging, to your point on what didn't seem to be all that well liked. They really shocked people in August when they announced that they would be acquiring for $18 billion JDE Peet's. So that's a European-based coffee company. They were going to be acquiring that for $18 billion and then subsequently splitting the businesses into two. So merging the coffee assets and then leaving the U.S. beverage assets as a separate company.
Well, that's what I'm curious about. I mean, when the JDE Peet's thing was announced, a lot of people kind of scratched their heads. Is there still, despite some of the recent issues with regards to coffee bean prices, et cetera, is there a long-term future in that space?
Sure. I think, the positive of this newly formed entity will be you're no longer wedded to one geography, more or less the U.S. or North America, nor are you wedded to one system, which is single-serve coffee through Keurig machines at home. So diversification generally, particularly in a very slow growth category, but stable like coffee, isn't a bad thing. The big questions and push points that people had on the legacy Keurig business has been, what will household penetration look like for these brewers? Is this the winning format over time? Consumers have expressed, and doing it, every day, interest in cold coffee, concentrates, right? Different forms of coffee are winning. And I think the original supposition of household penetration for these single-serve brewers continuing to grow and grow is becoming a lot more challenged.
So there's going to be the coffee business, there's going to be the soft drinks business. Is there something in their portfolio in the soft drinks business that they need to add to it? Water, for instance, or energy drinks that they, there's a hole there.
Sure. So one thing that they've been doing over time and that the CEO had been talking about was their, quote, capital efficient way of expanding the portfolio. So what legacy Dr. Pepper Snapple Group had done was they had a strategy called the partner brand strategy. And the idea was to say, look, we've got a system, a route to market in the US that's not Coke, that's not Pepsi. And you burgeoning, exciting brands and exciting categories can get nationwide distribution in our system. That model has continued, and they've done it in a more disciplined way, but in this, again, capital efficient way, have been adding energy drinks to the portfolio, sports hydration to the portfolio. Now, this is a not capital efficient move to go out and buy JDE Peet's, which is what one of the big shocks have been. More recently, the CEO has talked about interest in protein and healthy modern soda. Those are kind of two portfolio gaps that they had discussed adding to. But frankly, in the near term, with the leverage profile this business is going to have, I think that gets tougher.
Is there anything you see in the horizon that would prompt you to downgrade yet again to the equivalent of sell?
So it's already sort of I feel like the market has spoken, let's put it that way. The leverage, I think, is what is really reflected. There's two things going on here. I've mentioned the shock. People have been really surprised by this move. There's going to be enormous leverage going forward. So at closing, it's going to be between 5.5 and 6 times leverage. The company has guided to closer to 5.2 leverage at the point of separation. So that'll be, call it this time next year. But that's just not very comfortable in the staples landscape. And I think that's currently embedded in the stock price. I feel like the future disruption, we're kind of expecting it. So no, if I wanted to go further on this downgrade, I would have.
All right, well said. Lauren, thank you so much. Lauren Lieberman is an analyst at Barclays Equity Research. Coming up on The Close, Janus Henderson CEO is here to lay out what's next for his business and how the asset manager is navigating a tense macro landscape. This is The Close on Bloomberg. World leaders descending on New York City for the United Nations General Assembly this week, so we want to take you there right now. Bloomberg News editor-in-chief John Micklethwaite is sitting down with Spain's Prime Minister Pedro Sanchez. John?
Scarlett, thank you very much. Pedro Sanchez, Prime Minister of Spain, thank you for talking to Bloomberg. It's a pleasure to have you.
It's a pleasure.
I just looked, out of all Europe's leaders, you are the one who seems most prepared to disagree with President Trump. You champion the cause of recognizing Palestine. You pushed against the 5% limit on defense spending. You've also been very close to China. I mean, when you heard his speech yesterday, which seemed to depict Europe as a kind of hellhole, do you think that was aimed at you?
Well, I think I'm respectfully disagree with President Trump's statement because, he took migration and climate change as, I would say, the major challenges that we have to fight against for. And I said, well, look, if you took the experience of Spain, it's the contrary. So thanks to these green policies, we have dropped the electricity prices since 2017 till now by 50%. So that enables us to gain competitiveness. And thanks to that, we are witnessing this extraordinary outcome of the economic growth in Spain. We represent 30% of the total economic growth of the European Union. And when it comes to migration, in the last 7 years, we have received 2 million migrants, while at the same time we have dropped by 40% the unemployment rate. So all in all, what I'm trying to say is that green transition and migration, when it comes on regular basis, are positive for the economic development of a country.
Do you think your fellow leaders in Europe could be braver about making those comments?
I think that we need to keep transatlantic bond and to strengthen that transatlantic bond. It is indeed true that we need to combine it with other policies, such as, for instance, trade diversification. That is why we've been very vocal in reaching this agreement between the European Union and Mercosur, which it will be definitely a game changer in our economic ties with other regions of the world. And second, what we need to do within the European Union is to do our homework, as the former central banker Mario Draghi always reminds us. And that means that we need to deepen single market, that we need to review our competition policy in order to scale up big companies in Europe and try to be, as good, as competitive as global corporations are in the US and other parts of the world.
It's very interesting, though. You look at what's happened. Your economy has grown very well, 2.7%. You look at what's happening in other countries on the periphery, like Greece. There is a very interesting thing. A few years ago, we were used to saying the periphery is the problem and the core is great. Now it's the other way around. France, Germany, Britain, barely growing at all. Do you think it is now the center of Europe that is the problem in the economy?
No, not at all. I mean, Germany is a big country, big economy, also France, and we always expect a positive, let's say, dynamic in their economies. But it is indeed true that from the south we can contribute to the economic growth of the European Union. So, for instance, when you see that 60% of the electricity generation in Spain comes from renewable sources, that means that we have a potentiality that we can contribute to the strategic autonomy.
You have problems
energy.
Exporting that, don't you, to France? Where they...
Yeah, well, okay, we need to interconnect better our grids, but we're trying to convince our friends in France to do so. So all in all, what I'm trying to say is that if you see the economic figures of the Southern Europe, especially Spain, that represent, and I said before, 30% of the total economic outcome of the European Union, that means that we have achieved many reforms that were demanded by the European Commission over the last years. So we have achieved to reform our labor market, our pension system, our educational system, and also our energy policy and digitalization, along with the contribution of migration. So it is true that these pillars also show that the economic background or pillars of Spain are quite solid if you compare it to previous periods such as the one before the financial crisis.
I'll ask you a selfish question from the point of view of all the foreign investors looking at this. Many people want to invest in Spain for all the reasons you said, but you want to introduce 100% tax on them if they want to buy a house there, a second home.
No, not at all, not at all. What we need to face is a real challenge that I think that across Europe and also in England, in the UK, you're suffering, especially the youth, but not only youth, which is the lack of or the impossibility to access to a house, or to emancipate in the case of our youth. What we did is for all British people or European people that want to buy a house for living, they won't pay taxes.
But if you do.
Yeah, but this is the point. No? We need also to understand that we need to solve a problem of housing that we have in Spain. But all in all, if you see now the figures of the real estate sector and how we are speeding the process of construction in Spain is quite amazing. Nowadays, we have increased by 63%. Construction of, let's say, public housing, whilst the private sector has increased like 13% during the last year.
Can I ask you a bit about the relationship between the economy and politics? The economy seems to be going very well for you. In politics, it's harder. Your party is behind the Partido Popular. You've also got Vox coming up, this much more right-wing outfit. And in the current polls, you would lose if at the election. What do you think the problem is? You've got a good economy, unlike most other European prime ministers, and yet you're still behind.
Polls are polls. I mean, of course, you have to look into it. You have to see. What I am defending is that, unfortunately, we're seeing not only in Spain but across Europe a political collapse of the center-right traditional parties, which, by the way, it started after the financial crisis with the failure of governments with all this rhetoric of austerity, banking and the financial rescue that we had to pay with taxes all around Europe. And what you see now from the center-right is that they are copying not only the way of doing politics of far-right, but also the contents. So you see now that they are like identifying migration with insecurity, which is a fake. It is not true. And by the way, as I said before, when you see the figures in Spain, you can see that we have the contribution of migration, but at the same time we're reducing unemployment rates in Spain. And there are sectors such as construction, agro-industry, or social services, or tourism, which in Spain are quite important, where up to 20–30% of the total workers comes from different countries and not Spain. So what we need to do is to face that we need migration, but for that migration what we need to open is a path of regular migration. And this is what we are doing with many countries in Latin America, also with the US administration, with the previous administration. We reached a very interesting program in order to have this circular migration coming from the US and of course some countries in North Africa. But all in all, the contribution of migration to the economic growth in Spain is quite positive.
Sounds as if you're bridling for that fight. So you will definitely lead the socialists in 2027 into the election.
Yeah, I will do it for sure. This is something that I have already spoken with my family and with my party, and if they allow me, I'm confident that we can repeat a majority and to keep the work ahead. No, but let me add, coming back to migration, that the dilemma that all Western societies we're facing is whether we open up and grow, or we close off and shrink. This is the real dilemma that we need to face. So the challenge that we have within the European societies is how do we integrate this migration.
Do you think it's easier in Spain because you get a lot of people from Latin America where everyone speaks the same language? That's at least part of the argument why you might have been better.
So when you listen to some center-right parties and the far right, they are saying, no, well, we need to expel all these migrants coming to our... Okay, so what we do with demographics? Because either you have family policies?
Yes.
Plus migration, but they don't propose anything in these two policies. No migrants, and less welfare state, and therefore less family policies. And that means social services, healthcare, social security, and so on and so forth. So what I'm trying to say is that if we don't have this contribution of migration, what we will face in the coming years in Europe is that we have a stagnation. We won't have the capacity to grow, and therefore there will be more cuts in our welfare state. So this is something that we need to explain to our citizens, that if we articulate a positive migration policy, that would be for the good of the Europeans and the Western societies. So just to give you a figure, 94% of the total migrants that are living nowadays in Spain came from regular, let's say, systems, and they came on legal basis. So we're talking about only 6%, and this is the reality. So I think that we need to fight and to give a positive, let's say, message about the contribution of migration to our societies and to our prosperity.
That will be a fascinating debate, which I'm sure every other European leader will get stuck in. Pedro Sanchez, thank you very much for speaking to Bloomberg. Back to you in New York. Thank you.
Our thanks there to John Micklethwaite, Bloomberg's editor-in-chief, and of course, the Prime Minister of Spain, Pedro Sanchez. Meanwhile, back here in Studio 2, we continue to count you down to the closing bells here on this Wednesday afternoon with a closer look at what's going on in the asset management industry. Momentum has been building over at Janus Henderson, with the asset manager raking in almost $47 billion in net inflows just in Q2 alone. The firm now announcing a strategic partnership in the private credit space. This on the heels of agreeing to manage the public fixed income asset portfolio for life insurer Guardian. That was earlier this year. Joining us live to discuss what's next is the CEO of Janus Henderson, Ali Dibadj. Great to see you, Ali.
Great to see you, Romain. Thanks for having me.
Let's talk about this new deal. Victory Capital, CNO, a push into private markets, a push that you guys have already sort of flirted with already. But we're seeing asset managers across the board now start to look at this as a growth area. Where is the growth?
Well, the growth is very broad, I would say. So first off, just from a fixed income perspective, given where we are on the cost of capital perspective and yield, fixed income has become relevant again. It wasn't relevant for many, many years, and now it's actually quite relevant. Now, we believe that there's a lot more opportunity in the securitized areas of fixed income, much more than corporates, much more than high yield. And so for us, we have two particular areas. One is on the public securitized areas. So those are either shorter duration, higher quality, like JAAA, which is an ETF that we have that's crossed over $25 billion for us. We go a little bit further on the duration curve on JMBS, so mortgage-backed securities, again, still pretty high quality, or JABS, JABS, which is a broader basket of securitized, again, still in ETF form, but again, a little bit more duration. Then there's the private side of things, which is a Victory Park Capital deal. Victory Park Capital, to us, we're biased obviously, but is the best asset-backed investment house in the world. We partnered with them just a little while ago. We purchased a majority stake in them. And what we see is this enormous opportunity to find differentiated returns, really uncorrelated returns by investing in asset-backed on the private side.
I do have a question, though, on the fixed income side. And we know fixed income has been hot, but there was a reason why it wasn't hot, because you weren't really getting much, at least on a yield basis. Given where we're at with yields right now, given that market expectations seem to be firmly in the camp that yields are going to go lower as the Fed cuts, assuming that comes to fruition, do those strategies still work in an environment with declining yields?
Yeah, it's a great question. The short answer is yes, right? Because our view is very much, yes, you've probably seen peak yields in the U.S. from a Fed perspective. You may see one or two other rate cuts over the course of the year. Now, the markets may be saying 3. We think at Janus Henderson maybe 1 or 2 more. But even then, you're never going to get to zero yields at any time soon, it feels like. You'll still have a real yield in the marketplace. Now, you're exactly right. When there was no yield, there was no diversification, wasn't really purpose to have fixed income. Now there is, right? And for us, what people will decide to do, because what's happening with rates is they're coming down, you're going to look for things that are safer on one hand. Again, that's things like JAAA, that's things like Victory Park Capital and their asset-backed side of things, or go a little bit further on the duration side. Again, those are things like mortgage-backed securities, JMBS or JABS as well from a fixed rate perspective. I think there are still some real opportunities. Now, one thing I would say on the yield view is there's a fixed income element to it, but let's not forget when there is a cost of capital, equities become more interesting too. In particular, picking between a good company and a bad company, which is what we do at Janus Henderson. We're active asset managers on the equity side as well. That's actually quite interesting and exciting.
I want to talk about big picture. You joined the firm at a time where it was suffering consecutive quarters of outflows. There was pressure from activist investors. There was competition from low-cost passive funds and ETFs, which you've now entered. You had to seek out new growth drivers, and we talked a little bit about the expansion to private credit, private assets, and you had to streamline the business to double down on your strengths. When it comes to scale in this industry, everyone seems to want scale, but when is scale not good enough and maybe even bad?
Yeah, Scarlett, thank you for your support throughout the past 3 years that we've been here. We've had one of our earlier conversations, actually, and you're right. Janus Henderson was outflowing for 21 consecutive quarters. We were dealing with negative flows in the tens of billions of dollars, and now we're very much on the right foot. Think of $40, $50 billion of net inflows now, a real reversal. The team has done a great job. And to your question, we haven't done it because we're seeking a scale of size necessarily. Well, we are seeking a scale of scope. And just to differentiate that, what that means is we're being client-led. So when a client needs something, we're here to support them if we have the capabilities to do it. That includes, you're right, the active ETF side. That includes the private credit areas as well. That includes some other areas. So one of the things that we're seeing very much in the markets today is a move away from the U.S. The U.S. has become 65% of people's allocations. It had been 50% 10 years earlier than that, to non-U.S. And we do that both from an equities perspective and a fixed income perspective. So things like JEMB, which is an ETF that we have on emerging market debt. We have an emerging market private credit business as well that we deliver, but also on the equity side. We are very, very global. We have a very strong European equities investment team, for example. That's something that we look
I'm curious, though, but that rotation that we saw earlier this year into European, or at least non-U.S. assets, you think that has staying power?
I think it certainly has staying power. Now, to be fair, I don't think the U.S. is gone off of people's radar screens. A lot of people ask us, certainly to your question, how do I make sure I can navigate these geopolitical risks and ups and downs? We again think globalness that we have certainly helps them, but we also try to pierce through the geopolitical unknowns. So, for example, innovation. We spend a lot of time, a lot of our analysts, we have 350 investors around the world, focusing on innovation. Two ETFs that come to mind for us, one is JXX. We focus on the 20 top innovative companies, the real kind of industry breakers out there on the large cap side. That's a great way that we can manifest our interest there. For example, Oracle is part of that group, is one of the biggest holdings. You saw it happen a couple weeks ago, and there are more we think to come. The other one is on AI, so JHAI. It's not just AI in terms of just the companies that are directly impacted by AI, but it's the others. It's the power sources, it's energy, it's everything else. And so we bring those to bear. So innovation really does pierce through the geopolitical concerns as well.
I like what you said earlier.
Sorry, I'm just going to interrupt, Scarlett. Just speaking of AI, we do have some breaking news crossing the wire right now. This is according to Bloomberg reporting, this involving Intel. And Intel is said to be in talks with Apple for an investment as part of its comeback bid. Again, people familiar with the situation that spoke to Bloomberg reporters say that Intel has asked Apple to make a multi-billion-dollar investment into the company. There are a lot of details that we don't know about this. Intel getting a quick spike higher, Scarlett, up about 8%. But this seems, assuming that it is true, this would be reminiscent of the investment, the $5 billion investment that was just announced a few days ago.
And of course, you also have the U.S. government owning a stake in Intel as well. So Intel seen as a national champion in a way of, given that it has a reliance on U.S. government loans from the CHIPS Act. But Intel getting a big boost, currently up about 7.5% in trading right now. Again, the reporting is that Apple has been approached by Intel. Ali, let's just bring you into this conversation. How are you thinking about something like Intel, which it feels very much like the tech companies, the mega cap tech companies, are just spending their time investing in each other? Does that complicate our technology industry and the options it provides to investors?
Look, I think it really underlines the fact that this is an ecosystem, right? And what we've seen in other builds.
But an incestuous one.
Hopefully a symbiotic one, right? Let's just say. I think, look, this goes back to other types of situations, whether it be going back in history, we were 91 years old. We were the first to invest, for example, in railroads. That was a big investment that had to go through, or electricity, or the internet back in the time. I think what you found is the ecosystem was creating value, not necessarily just the rails, so to speak. I think that's what you're seeing. I don't know much about, obviously, this deal. We don't know much about the headline. But what you're seeing is this is an ecosystem, and understanding how to actually take advantage of AI is what all of us need to do, whether it be Apple or Intel, or frankly, whether it be Janus Henderson applying AI to the way we operate.
And this gets to also when you were talking about this idea of having a global focus. And I know the AI trade certainly seems to have been very U.S.-centric, at least in terms of the investor interest. I am curious as to what it looks like outside of the U.S.-based companies. Are we going to be talking about Alibaba? Is it going to be a conversation about Taiwan Semi or some other, I don't know, has Europe gotten their act together on AI yet?
You are seeing clear pockets. So Taiwan Semi, everybody talks about, that's been around for quite some time. Alibaba coming back into people's focus areas as well, certainly in our focus area too. I do think that you'll find is there will be champions, maybe regionally, but on the infrastructure that's being created by AI. I mean, clearly there's a huge need for the infrastructure to be created. Right now, NVIDIA is the one that's making the most money off of this, but others are going to benefit from it across the board. So we do think globally for sure, and that's a place that we certainly believe there's opportunity for investors.
All right, Ali, thank you so much for joining us. Janus Henderson, investor, CEO, Ali Dibadj. As we mentioned, Intel has approached Apple about securing an investment in the company. This is according to Bloomberg reporting. This is as part of a bigger comeback bid. Let's bring now Bloomberg's Ryan Gould for more on that news. Congratulations on the scoop. Tell us what we need to know right now.
Yeah, I think this is clearly breaking dynamic, but these are early stage talks. I can report that Apple and Intel are in early discussions around a potential investment. Intel has reached out to the company about how ways they could work more closely together. This clearly comes on the back of NVIDIA's investment in Intel a few weeks ago, $5 billion. We saw earlier in the month, or maybe last month, that SoftBank as well has pledged $2 billion to invest in Intel. So this is part of its comeback bid. This is kind of Intel saying it's proactive. It's here to really shore up its balance sheet. It wants help. And I think it's really showing the U.S. government, which is one of Intel's largest shareholders, that it's there and it's ready to explore its options.
I am curious, Ryan, about the idea of sort of who's nudging who on this, or if you have any insight into that. Also, I noticed the story that you reported didn't actually have an actual number. When we talk about multi-billion, are we talking about a $5 billion investment or $20 billion? Do we have any sense of just how big this could potentially be?
At this point, Romain, no. But I think if you just base off what we've seen with NVIDIA, with SoftBank, I mean, if you're talking about someone with the balance sheet that Apple has, and Apple's already pledged to invest $600 billion in the United States over a 4-year period in part of its in partnership with the Trump administration. I think you're looking at something that will probably be in the billions. But again, these are early stage talks, and as to what that looks like, we don't know yet. I think could this be a chips deal? Could this be manufacturing? Could this be packaging? This could be one among many things.
All right, Ryan Gould of Bloomberg News, a scoop on the Bloomberg terminal right now. Call it up. Intel has approached Apple about securing an investment in the chip maker. This could be a multi-billion-dollar investment, according to people familiar with the situation that our reporters spoke to. You're seeing shares of Apple move lower, but a big spike in Intel shares up about 6% as we move closer to those closing bells, which are just about 6.5 minutes away. Let's bring David Lebovitz into the conversation, multi-asset solutions global strategist over at JP Morgan Asset Management. David, great to have you.
Thanks for having me.
I had a whole set of questions to ask you before this news, but let's just start in on the AI trade, because we came into this morning with some relatively encouraging news. The earnings out of Micron yesterday seemed to give ratification. The AI spend continues. Alibaba CEO coming out and saying, that $50 billion we said we're going to invest over the next 3 years, it's going to be even higher than that. And now you have rumors circulating that Apple might be willing to take an investment in Intel.
So I think, I'd reiterate what the prior guest was saying about the ecosystem that's being created. But I also think it's important to step back and think about what's happening from a longer term perspective. So if you look at the world today, we see these forces of more active government spending, more economic nationalism, less migration, so on and so forth, beginning to impact the outlook for growth. The easiest offset to these headwinds is investment and investment in technology. And so I think what you're seeing has almost to an extent been catalyzed by some of the policies coming out of places like Washington, but really governments around the developed world. And we expect that it'll spur more investment going forward to try to address some of these shortcomings.
I have a question, though. As a strategist, and I don't want to get too deep into politics here, but there's been a lot of concern about statecraft, or whatever we're calling whatever's happening right now. Do you worry that some of the policies coming out of Washington might actually narrow the scope of market gains? The idea that there are just going to be the small handful of winners that are benefiting because of their proximity to political policies, rather than more of a broad market, investors deciding what should go up.
So I still think investors have the upper hand. I think one of the things that stems from all of the investment that you've seen, and I would even go back to the beginning of the year with the whole announcement around DeepSeek, right? The cost of using these tools continues to come down. And as the cost continues to come down, you should, in theory, see adoption broaden out. And so what started as a very narrow tech and communication story, in our view, is going to broaden out into things like financials, which we're already seeing, eventually into things like industrials, materials. I think that AI is going to be everywhere. It's a question of how much.
Romain and I had mentioned earlier to each other that we see in other countries, like Japan, for instance, a lot of companies buying stakes in each other, the cross-shareholdings. And I don't know if it's worked out for the better for the companies, for investors, for the government. You talk about this ecosystem that we're cultivating here with big tech in the U.S. At what point do we decide whether this is a good thing for shareholders?
So I think, to me, it has to do with the dynamism of these companies. And as long as you continue to see that innovation, as long as you continue to see that forward progress and that growth, I think that taking a stake in another company isn't the worst thing in the world. I think when it becomes right pocket, left pocket, and you're seeing the pace of improvement, the pace of productivity growth begin to slow down, that's where I would begin to get a bit more concerned. But one could say and look at what's going on today and say, this isn't really any different from what's been happening in private markets for years, where you have companies taking stakes in each other. The reality is these companies are so much bigger and so many of them have gone public that it's just more visible to the average individual.
How would the U.S. respond if companies in other countries were doing this to the extent that they are? I mean, we're talking about global champions here, that these companies are doing this, not smaller companies.
Yes.
So, this has implications for the rest of the world.
It absolutely does. And one of the things that we're seeing is that individual markets are creating their own national champions. One of the things that often gets overlooked when we talk to clients about investing outside of the U.S. is the concentration of those markets outside of the U.S. Everybody's been so hung up on the Mag 6, the Grade 8, whatever you want to call them. That, frankly, is a market dynamic that you see across the board. And so, the idea of having these large incumbent players in a given economy doesn't really give us pause as long as the growth is there. If the business model is no longer working and you have all your eggs in one basket, that's when you end up with a problem. But as long as you're seeing that innovation and that growth, we're frankly comfortable with the direction of travel.
I don't think anyone, at least no one sensible, is really doubting the AI trade. I am curious, when you look outside of AI and sort of the related tech sectors that have benefited from that, are you finding anything attractive in the equity market right now?
So we are. We think that there's a real opportunity here in financials. I think that services broadly will be a direct beneficiary of what's going on with AI, and financials are one of our best ideas. We do see some opportunity in parts of the industrial sector. We're a little bit more neutral from a portfolio perspective, but picking and choosing our spots based on the opportunities that we see. The areas that we're really trying to avoid are things like materials, which have the tariff target on their back. That's just not a game that we're interested in playing. But again, I would go back to what I said earlier, which is AI and technology adoption is a rising tide that can lift all ships. And so if we're right and these gains do broaden out in 26, in concert with the big, beautiful bill providing a bit of a tailwind to the economy, I think that the path of least resistance for the market remains higher.
David, before we let you go, I want to get your take on rates as well. Where would you be comfortable? Where do you want to be on the curve?
So the curve is a challenging one. It was a little bit easier before 10s came in as much as they did a few weeks back. We are primarily neutral on duration. We're viewing duration as more of a utility trade as opposed to an alpha trade. We do think that if the economy gets hit with a negative growth shock, you will see that offset from your fixed income relative to your equity. Much more comfortable being on the shorter end of the curve, though. It is a little bit challenging as Fed expectations have been repricing here, but we think that's a much better place to sit rather than the long end of the curve where you're dealing with things like risk premia and term premia moving the level of rates around.
We're in conversation right now with David Lebovitz, Multi-Asset Solutions Global Strategist over at JP Morgan Asset Management. As we count you down to the closing bell, it's just about 30 minutes away. And if you had asked me, I don't know, just about an hour ago, Scarlett, what the biggest mover was in the S&P 500, it would not have been Intel. Those shares spiking as much as 8% on an intraday basis after that breaking news here that company is potentially in talks to seek an investment out of Apple. That's according to people familiar with the situation. Intel making a nice pop, now on a 60% run since the start of August. Nevertheless, still not enough of a weighting here to push the broader markets into the green. It is red across the screen for a second straight day here in New York, with the Dow down about 0.4%, the S&P down 0.3%, the NASDAQ composite and the NASDAQ 100 also moving lower by a similar percentage amount. And Scarlett, the Russell 2000 down 0.9%. That small cap trade nowhere to be found today.
Nowhere to be found today. Again, all the indexes lower. And you mentioned Intel. I can see right now that the trade in that 23% above the 10-day average. So a big spike in activity, at least for that stock.
And David, I want to bring you back in and just get your thoughts here on kind of what the big risks are that you keep an eye on, because this is a market. We started off this show talking about, if not the euphoria, certainly the conviction that we are set to continue to go higher. There has to be something that you're keeping an eye on to make sure that rally doesn't get tripped up.
So to me, the biggest risk is less of a 2025 risk and more of a 2026 risk. And what I really worry about is that you get a Fed here which eases too far, too fast, in the face of economic activity that has proven to be far more resilient than people were expecting back in April and May of this year. And so we think that there is some need for easing. We're not saying that the Fed should slam on the brakes right here. Clearly, the labor market has had a bit of a wobble, but I worry that they extrapolate that weakness too far forward. Our interpretation is that the labor market, it's just kind of stagnating. It's not churning the way that it was. If you look at wage growth for job switchers versus job stayers, they're right on top of each other. And so you're not seeing that movement within the labor market. That's been reflected in some of the headline numbers, but you're not seeing a lot of firing either. And that gives us a bit of pause.
Yeah, good point there, David. Have to leave it there. Always great conversation. David Lebovitz over at JP Morgan Asset Management. The closing bells just about 2 minutes in the past. It was red across the screen for the major indices. The majority of the stocks in the S&P lower on the day. As we break down the price action, let's bring in Nora Melinda of Bloomberg News, as well as Jonathan Levin, columnist for Bloomberg Opinion. And guys, it was quite a day on the markets, but I do want to start with the upside. It was red across the screen, but there were quite a few names that did manage to post gains. Nora, you've been keeping an eye on the gainers. Who you got?
There were a few names that ended in the green today at the closing bell here. Looking at shares of Planet Fitness here, this is a company that ended higher. The stock ended higher after Jefferies reiterated a buy rating here on the stock. Essentially, Jefferies had discussions with top management, and they struck a bullish tone during those meetings with Jefferies. The company is saying that it's highly optimistic, particularly on its presence in terms of international developments. And we really are looking at Wall Street, really just positive on the stock more broadly. Of course, Jefferies is the biggest bull here. But if you look at Wall Street analysts, 90% are positive here on the company. 2 holds, 0 sells there.
And you're also looking at Lithium Americas.
Absolutely. This is a company that is called Americas. It's so interesting. It's in Vancouver. Makes sense. But at the same time, I was a little bit thrown there, I will say. I'm like, it counts, right? We count Canada.
Be careful there, Romaine.
Is it?
$1.4 billion market cap here, but it made some big moves at the closing bell here. Shares ended about 95% higher, and this is after the Trump administration is saying that they want to take a stake here in the company. Of course, we've been seeing the Trump administration coming out saying that they're interested in the government taking stakes in multiple companies. Intel is one that we've been talking about in recent weeks. But this was essentially during a renegotiation for a $2.3 billion loan here that was coming from the Energy Department here to Lithium Americas. And so we are seeing Wall Street really celebrating this idea. We saw a lot of activity, especially as well among peers.
Did you have another commodity stock on that board, or are my eyes deceiving?
Well, of course, I had to go over into aerospace and defense a little bit. Okay. One of the sectors that I love to chat about here. So let's look at AAR Corp here. We are seeing shares that also ended higher after the close. It's about $3 billion based in Illinois here, but it boosted its organic sales growth outlook, and especially this comes after it had first quarter results that topped expectations. So it seems as after they got those first quarter results, they're like, hey, we're going to boost the outlook moving forward. So we are seeing the street really coming behind this company, optimistic here at the close remain.
And just add a few honorable mentions here. Tesla getting a nice pop on the day, and some folks in the chip sector also moving higher, including Qualcomm and Intel. Jonathan, you're taking a look at the decliners.
Yeah, absolutely. Let me go first to Freeport-McMoRan. The company said Wednesday that 2 workers were fatally injured in that September 8th accident at its Grasberg mine in Indonesia. And sadly, it's still searching for 5 more. Obviously, big market impact here. It's affecting the entire copper price. The company said Wednesday that a, quote, return to pre-incident operating rates could potentially be achieved in 2027, right? So long wait to get back to where they were before this terrible accident. I want to turn next to Axon. The taser and body cam maker said Tuesday it was buying an AI-powered emergency communications platform. The reason the street is sort of uncomfortable with this, according to Needham's Joshua Riley, is they're saying the deal raises some uncomfortable questions about whether the company is actually getting back into a business that it effectively exited a year earlier. That would be the 911 computer-assisted dispatch market. And then lastly, I want to come to some White House news with Kenvue. We keep talking about this story with the alleged association between Tylenol and autism risk. it's been a wild ride for this stock since the Trump administration came out with this line. Of course, Trump himself warning against Tylenol use during pregnancy. You know, the FDA also wants to add a label to Tylenol that would say it's associated with autism risk. But important to underscore, the World Health Organization still saying there is currently no conclusive causal evidence here that the two things are linked.
All right, and I want to talk a little bit about yields, but also about the AI trade, guys. I mean, you take a look at where yields ended the day, and they were materially higher, particularly in the middle and the long end of the curve. The 5-year up about 5 basis points, the 10-year up about 4. And a lot of this seemed to have to do less with some of the macro conditions and more with this $18 billion bond offering by Oracle. Of course, this is to help finance that AI infrastructure build out. And the idea that when you start to get maybe some of these companies of this size, these high quality companies, I should point out, coming to market, the idea is that you're going to have to compensate investors a lot more to go into treasuries as opposed to the corporate fixed income space. And I do wonder if the AI trade that, of course, has already eaten up the equity market is now finally come for the bond market itself, Nora.
I mean, that definitely was something that we should be thinking about, especially as we're just thinking about the AI optimism that we've been seeing widespread here in the market. It doesn't matter what sector you look at. I mean, yesterday we were just talking about aerospace and defense companies and how they're really just trying to embed AI here into the story. So that's clearly what people are most focused on right now, Romaine.
All right, let me just jump in here because we do have some earnings news coming out. Stitch Fix, which is the online personal styling platform, reporting a loss for the fourth quarter. The loss per share from continuing operations was 7 cents. Revenue from that period was about $311 million. But the outlook here is what is getting investors excited. That stock now up about 20% in after-hours trading because first quarter revenue, according to Stitch Fix, will be at least $333 million. Analysts were looking for only about $302 million. In addition, full-year revenue will be anywhere from $1.28 billion to $1.33 billion. Analysts were expecting, on average, about $1.25 billion, actually just below that amount as well.
All right, we'll keep an eye on that. Of course, that's one of your biggest movers in the after-hours trade. We should point out we are still waiting on earnings out of KB Home a little bit later tonight. And keep an eye on Intel. Those shares continue to push higher in the after-hours trade. Our thanks to Nora, Melinda, Jonathan Levin. And we're saying goodbye now to Scarlett Fu, filling in today for Katie Greifeld. The close continues right here on Bloomberg, a discussion about that AI trade and, more importantly, a discussion about how it folds into the venture capital space. We're going to have a conversation with the CEO of General Catalyst, who has found an interesting way to play that AI investment. That's coming up next here on The Close. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Second day of a pullback in the broader market, though we should point out the losses have been relatively modest, similar to yesterday. 0.3% lower for the S&P 500. Similar moves lower for the Dow and the NASDAQ as well. Home builders did get a bit of a bid today. In fact, they actually had a pretty strong run over the last few days. And today we had a surprise data point here on new home sales, one of the strongest prints that we've seen in that space in several quarters. Meanwhile, keep an eye on the moves in yields. We were just talking about that during the simulcast. How now, while a lot of what you're seeing in the Treasury space is being driven less by the Fed and maybe potentially a little bit more by what's going on in the corporate bond space, and copper prices, a phenomenal run up higher, but not necessarily for the right reasons. In fact, you take a look at the board on this side here, that big drop that we saw in Freeport-McMoRan, the biggest publicly traded miner of copper and gold, taking a big leg down on the back of that accident that Freeport-McMoRan says will disrupt production of both copper and gold. Keep an eye on that space. Meanwhile, oil continued to move higher, as did most of the oil services companies. Halliburton now on a significant run, one of its longest runs that we've seen on a daily basis going back several weeks. Micron moving lower on the day, but Alibaba moving higher on the day. A bit of a flip-flop here. Micron had some relatively decent earnings yesterday, and more importantly, very strong guidance going forward, but a lot of people saying that a lot of the good news was already priced in. Meanwhile, Alibaba's CEO came out overnight and said that $50 billion commitment that they had made to invest in AI infrastructure over the next 3 years, it says that's actually going to be even higher, saying they actually see themselves becoming a full stack AI services provider. You're seeing a little bit of a pop there, but remember, Alibaba was one of the laggards in that space relative to Micron and some of the other names. And that brings us to our top story for this afternoon. And that, quite frankly, is the unflappable investor sentiment and when confidence actually drifts into hubris. Despite the slight pullback that we saw in stocks today and yesterday, the S&P has actually not had a meaningful pullback in weeks. Those pullbacks are typically seen as a healthy sign that kind of allows the market to reset for additional gains while keeping a cap on the euphoria. For now, there doesn't seem to be much of a cap. The last time the S&P dropped 1%, that was back on August 1st when we had those downside labor market revisions in the U.S. And the last time the benchmark dropped 2%, that was April 21st when Trump amped up his rhetoric about firing Fed Chair Jay Powell. That all seems quaint right now. In fact, it's been 107 sessions since the last 2% decline, the longest stretch since July of 2024. And while risks to the market abound, like narrow breadth, like a lack of hedging, and quarter-end rebalancings next week, the positive catalysts for now are a bit too far numerous to turn your nose up at. Confidence in lower borrowing costs, confidence that inflation will be contained, confidence that the AI boom will continue to splash the corporate cash. All of this setting up maybe potentially for a continued run-up in asset prices. Mimi Duff joins us right now. She's the head of the New York office and senior client advisor over at GenTrust. Mimi, great to have you here.
Thanks for having me.
You know, it almost seems trite to ask a question as to where you think stocks will go, but I am going to start with that. Not so much asking you for a price target, but when you look at sentiment and you look at corporate fundamentals and economic conditions, is there any sense that there is any real impediment to stocks moving higher?
Well, I think in this type of market, you have to own them, right? I mean, the momentum on the upside, some of the stories around AI, as you mentioned just now, the growth story, GDP tracking north of 3% on some of the Fed trackers right now, where there's a bit more concern. Obviously, the employment figures have been really tepid. Yeah. So, you know, we're going to need to watch and see how that plays out on the broader economy.
When you talk to clients, are they worried at all about what they're seeing in the market, or are they worried about, I guess, where things are, or are they more worried about missing out on any additional upside gains?
I think there's some FOMO.
Yeah.
There's certainly some FOMO. I would say if there's consistency in questions from our client base, it's is the FX trade over? That's a very consistent trade or questions that we're getting. Another one, AI, is it overvalued? Where do we see that going? Those are two of the big themes that we're seeing. And then what's going on with employment.
And with employment. And this gets to this idea of what the economy looks like. I mean, look, you had the OECD yesterday come out and say, look, they expect some impact from tariffs, but they didn't meaningfully downgrade their growth outlook. And I know those GDP numbers, those forecasts are a little squishy, but you would think that if they were really worried, you would have seen a more material ratchet down of that.
They actually upgraded versus their prior global growth estimates. Okay. I think that was more of a mark-to-market, but that's right. I think that's accurate.
So if growth holds up and the inflationary scenario from tariffs at least isn't as bad as what some people thought,
right?
Do we need a rate-cutting cycle?
Well, I think that this is the big question, and even amongst the Fed, we see the dispersion in that dot plot. We see that Powell called it an insurance cut. I think they're waiting for more information at this point.
With regards to where investors want to put their money, we were speaking with Ali Dibadj over at Janus Henderson. He's obviously banging the drum, talking his book to be sure, but banging the drum with regards to fixed income and to a certain extent some private assets. But I do wonder if we are at the start of a rate cutting cycle, does the fixed income trade still work as a lever in this market? I don't mean just as a hedge.
Right, right. So I'll say in the municipal bond market, actually, munis got very cheap as the muni curve steepened much more than the Treasury curve earlier this year. So we still think there's some opportunities in that space. Duration has played out well this year already. Credit's played out very well. We do still have a tilt toward emerging market debt, also done very well. So we think there's a place for it, absolutely. And we don't think that was the last cut. Neither does the market. But from here, we believe in diversified portfolios. You got to own the non-U.S. equities as well. We have allocations to real assets, too, which have benefited greatly this year. Some of the gold and uranium positions that we've held for a long time have really played out well this year. So,
with regards to geographic diversification, you see staying power in that. I mean, we saw people really start to take a closer look at that earlier this year for political reasons. But at some point, people saw a fundamental reason to do so as well.
I think the primary driver to take a look is these markets have they've really beaten U.S. markets. Let's say that. We do see staying power. If you look at economic cycles, tend to be 6-7 years. FX cycles much longer, 15 to 20 years. So we're really watching some of the drivers of what's going on there, the rate differentials. We think there's more to go there. So we definitely wouldn't fade that trade just yet.
And when you talk about real assets, what are we talking about?
So we like commodity producers as part of this is the basket that should perform well in inflationary episodes. And alongside that, like I said, we have exposure to precious, gold, uranium. Uranium's up more than 80% this year. That's been a star in our portfolios. But that's a primary, it's a mainstay in our portfolios, this basket of real assets.
But with the uranium, was that sort of a play on energy?
Energy diversification over a long term. We think that nuclear is part of the long-term solution.
What about some of the other minerals and substances that go into, if not into the energy space, but obviously things like electric vehicles, and of course there was a big investment yesterday in Lithium Americas by the U.S. government.
Yeah, we don't have lithium in our portfolio specifically right now, but those are sorts of things that we're taking a look at.
So at the end of the day, as we get through this year, I mean, I kind of feel like I don't want to start talking about 2026 already, but I mean, look, we're at the end of this quarter. We're going to see a little bit of a rebalancing. I mean, everyone is expecting some selling, given some of the gains that we had over the last few months. But as we get into 2026, do you think the risk appetite is going to be as strong as what we've seen kind of since, May, June, July, August?
It's really interesting because coming into this year, folks didn't have big risk appetite, and we're putting in a very strong year. So I think that we just need to stay humble and see how things progress.
All right, Mimi, always a great conversation.
Thank you very much.
Mimi Duff is the head of the New York office over at GenTrust and senior client advisor. When we come back, we're going to go back to that breaking news on Intel, Apple, and a potential investment in the chip maker. That's coming up next here on The Close. This is Bloomberg. We do want to bring you some breaking news on KB Home, the home builder here in the United States, just out with earnings. It looks like they did beat on several key metrics. EPS in the most recent quarter, $1.61. The street was looking for $1.51. Revenue coming in just in line with estimates at about $1.62 billion, and deliveries overall 3,393, which is above the average of street estimates, 3,355. We're going to take a closer look here at the guidance going forward, because the company did say that it does see full year housing revenue in a range of $6.1 to $6.2 billion. That's actually below its previous guidance of $6.3 to $6.5. That might explain why you're seeing a slight dip in the shares there here in the after hours trade. KB Home down about 1%. Meanwhile, Intel up about 0.5% in the after hours trade after rallying about 6 to 7% into the close. This on the back of a Bloomberg scoop that the company is seeking an investment from Apple as part of its comeback bid. Caroline Hyde joins us right now, the co-host of Bloomberg Tech. And Caroline, you've been busy this year when it comes to the AI trade. And
so hasn't Intel, so is Apple.
Yeah, and this is what I'm curious about. I mean, Intel was kind of the also ran. I feel like, a few months ago we were talking about, okay, Intel's over, just pay attention to NVIDIA. They get a new CEO, they get a couple big investments, including we learned from NVIDIA, and now potentially maybe one from Apple.
Yeah, it looks as though they're going out to Apple and maybe to other players saying, put money in us. Because, hey, the US government's put 10% in. And we had Scott Besson on Fox News earlier today saying that NVIDIA investment that came to the tune of $5 billion in Intel vindicated the US government's purchase. So I'm sure that as Apple is out there saying we're committing $600 billion to US domestic investment, remember they put money into Corning, one of their glass suppliers. Yeah. They've been looking at ways to ramp up, maybe it's AI servers. You can understand maybe Lip Bhutan goes to Apple and says, hey, what about us? What about the future of domestic chip manufacturing here?
Well, this is what I'm curious about. And with the caveat, there's a lot we don't know about this deal. And so I don't want to put you too much on the spot here. NVIDIA investing in Intel kind of makes sense to me, long term, sort of. Apple, I thought, was kind of going on their own when it came to chip development. So kind of explain, where do we stand with their own chip ambitions?
Well, in a way, NVIDIA and Apple are the same. They're both designing their own chips. NVIDIA doesn't manufacture its own chips. TSMC does that. Apple doesn't manufacture its own chips. TSMC does that. Now, TSMC is building manufacturing prowess here in the United States, and there was a lot of talk at one point that maybe TSMC would be sort of nudged in the direction of investing in Intel. Of course, TSMC would rather just invest in itself. So what about Intel getting investment for the longer term? Now, the NVIDIA deal into Intel wasn't about the future of manufacturing. It's about the future of them sharing innovation together in some way and sharing the future chip design. But what about maybe longer term NVIDIA saying, look, I can actually make my chips using a domestic champion in the longer term? Maybe Apple can see that way too.
But that was a good point, because everyone kind of said there was no real discussion when they had that press conference. They were standing there, in different worlds or whatever, and about sort of what the future of that fab business was. And it gets to this idea. I mean, you mentioned Apple is using TSMC. I mean, what does Intel's fab business, at least as we know it today, actually bring to the table that TSMC or one of these other manufacturers can do? National
security. And I think this is where all the CEOs have been at dinners at the White House alongside the administration, who are calling on domestic champions for the United States. Yes, they want to, of course, bring domestic manufacturing from TSMC, from Samsung, but really they want US champions to domestically build. And I think that's in many ways why Lebovitz has had to re-involve the US government and have to come. It was after their earnings, remember, where it sounded as though Lebovitz was walking away from fabrication, moving away from the manufacturing that had been Pat Gelsinger's big play. But now it feels as though that's really going to have to be the national security answer for the future. So I can imagine this is all just people familiar. This is, of course, just initial discussions and nowhere near close to a deal. But you can understand perhaps the vindication from a national security perspective of Intel needing money to put to work to actually fabricate in the US, particularly in Ohio, where J.D. Vance, of course, used to be a key lawmaker and is now VP of the United States. And we might see, therefore, it being useful for Apple to continue to domestically invest as well.
Yeah, it's kind of weird, too. I mean, Apple used to kind of be in bed with Intel back in the day, right? And then
they moved away.
Go it on. Also interesting to see the price reaction. Were you surprised that Apple shares would go down on this?
It's interesting as to whether or not there's people wanting to see Apple really commit to the generative AI focus and to the AI server focus rather than perhaps manufacturing of chips. But this really serves Intel, where we see a big $8 billion market cap increase.
Bloomberg, Caroline Hyde, co-host of Bloomberg Tech, a closer look at the AI trade, and we're going to do it through another lens, the lens of venture capital, with Hemant Taneja. This is Bloomberg. All right, as we've been talking about all day, AI spending is hitting a fever pitch. Alibaba earlier today boosting its AI budget above that $53 billion target it had announced earlier this year, and NVIDIA and OpenAI inking a $100 billion data center deal. Our next guest is out with a new book called Transformation Principles: How to Create Enduring Change. It's about navigating shifting tides of technology and geopolitics. He's the CEO of the venture capital juggernaut General Catalyst. Hemant Taneja, pleased to say that he joins us now. He was an earlier investor in Snap, Stripe, and quite a few other companies as well. And I feel like the tone and texture of your book is sort of ripe for the environment that we're living in right now. We mentioned the OpenAI NVIDIA deal, the investments into Intel, obviously whatever commitment Alibaba and some of these other companies are making in AI. When we talk about these investments in AI, it's usually through the lens of the hardcore technology companies, the chip makers, the hyperscalers as well. You've taken a little bit of a different approach, at least as of late, with some of your investments. The idea of taking AI and that technology and applying it to companies that maybe aren't traditionally we would think of as being in that tech space.
Yeah, first of all, thanks for having me.
Yeah.
Look, I think if you think about the staggering amounts, we talk about 10 billion, 100 billion, 500 billion as though they're like small numbers. So the amount of investment going into AI, you often think about how we're going to recoup that investment and create value. At the end of the day, if you thought this new AI technology is going to replace the IT budgets of our companies and that's enough to recoup that value, that's not enough. What you have to be able to do is essentially take the work itself, what people are doing in these companies, to replace that with AI. That's really how you're going to have enough of a market to justify the investment that's being made in the infrastructure. And the moment you start thinking that way, you start thinking about, okay, but which companies can actually transform and really use AI to transform their workforce transformation that needs to happen with it.
So where do you look first? I mean, is it just sort of, let me find an inefficient industry or inefficient company? How do you do that?
So if you take any company, I've sort of often said there's like 4 things that need to happen to really create a diffusion of AI in the company. One is does the company have the data infrastructure so it can adopt AI? Second, is the company building intelligence and models that use all the what the AI labs are producing, but sort of harmonizes it for its own business? Third is you got to change the workforce. Because now you're going to have AI agents and human agents doing the work in your company. Think about the organizational chart of a new org like that. And the fourth, which is often overlooked and why I think diffusion of AI is actually slower than we would like, is courage at the top. You need the CEOs to drive this change. So when we look for what are the companies that are ready to adopt, we look for all four of these criteria.
Are there certain sectors that you think are sort of more ripe for this change than others?
Yeah. First of all, AI hit the zeitgeist, right? First time a technology shift where every CEO in every company, in every industry, in every country is talking about doing AI. The one industry that really surprised us, where we thought we would actually be slow to adopt AI, was actually healthcare. Because it's people's lives and the responsibility is great, and so the clinicians would be resistant to change. But because they were also burnt out with COVID, when this technology was presented to them, they said, give us anything that can give us some leverage, because we need help. And so healthcare industry surprisingly has been one of the fastest adopters of AI. And we're doing a lot of work in that area on different parts of how to transform that industry.
What parts of that? Is that more of like the record keeping and intake type of task, or is this more of the actual medical processes, diagnosis?
Great question. It's actually all of it. So it starts with the patient experience, and a patient comes in, how do they even fill out the forms and the intake and all that sort of administrative stuff, keeping an understanding of which patients need help proactively, because ultimately that's part of the mandate for the healthcare systems. That's one. Second is physicians and nurses, huge burnout. Because they have to go take care of the patients and take all these notes, and can we actually use AI to do all that work for them so they can focus on just the patients? So that's a huge area of AI development. Third is, can you use it to diagnose what's going on with people? So if you're a radiologist, can you actually have AI look at the radiograms and help you figure out where you need to focus versus reading all thousands of them that come your way? And then the fourth is payments. How do the hospitals actually get paid? The relationship between payers, providers, reimbursements, how do you really automate that? Revenue cycle management. All these areas are actually transforming rapidly with AI.
I am curious, as you search for companies to invest in, how do I put this diplomatically? There's a lot of people that are slapping AI in their name or in their presentations to make it seem like they're a little bit more tech forward than they really are. How do you sort of separate the wheat from the chaff? How do you know who's really doing this organically and doing it the right way?
Yeah, so I mean, this is peak ambiguity, right? It's very unclear how and what the business and the economy is going to look like on the other side of really adopting AI as society. So first thing, I'm looking for companies that do follow a lot of what we wrote in the book with the transformation principles. Are they really thinking long term? Are they actually really focused on driving change in their industries, radical collaboration? So that's one that we're like very, very focused on. Second thing is, I think any good company, they're going to be AI native themselves. Are they actually adopting AI and learning what it's like to bring that into your own workforce if you're going to go serve other businesses with it as well? So you do want these AI native companies. A lot of companies that started more than 3 years ago will say they're AI companies. Some were able to make that transition, but a lot haven't. And they do slap on the AI moniker just to be able to raise effectively. But that's not the kinds of companies that will actually make it through and become enduring.
Are you worried about valuations, particularly in the private market? We talk about elevated valuations in the public market, but then when you look at some of the recent funding rounds for OpenAI, Anthropic, which you're part of as well, does it concern you at all, some of those valuations?
I'll give you a nuanced answer. I think some companies, if you look at Anthropic's financing, I mean, the round that just got done, in some ways that was like one of the cheapest rounds from a valuation and multiple perspective that got done in the AI hype cycle. So it's a mixed bag. Some are actually okay, but then there's a lot of money going into research at insane valuations with the idea that the prize is AGI, and so almost the valuation doesn't matter, because you just got to make sure this company can do the research and maybe it'll get to it. There you'll see most companies will fail. There'll be a lot of money lost. But the ones that get there will obviously create some extraordinary outcomes.
When you hear people talk about AGI, superintelligence, or whatever the moniker is, does that seem fantastical to you or something attainable in our near future?
First of all, it means different things to different people. It's sort of very hard to sort of understand. I decompose it into what is the intelligence needed to create and sort of solve the different problems in different industries. And I think there's a lot of work being done where founders are building companies focused on those verticals. those intelligent systems ultimately will be the ones that those industries have trust with, as opposed to a sort of a generic super intelligence. So on one hand, we want to create these sort of models that are really, really smart, keep getting smarter, but you do still have to figure out how to apply them to each of the industries and each of the use cases and build trust with the industry, but they would want to use that technology as well. So I think it's a nuanced set of innovations that need to get done.
With regards to the types of models that some of these companies are using, some of them are clearly proprietary and maybe potentially that provides a bit of a moat down the road. Others are decidedly not. Does that matter to you?
Look, I think these models at some point are going to become affordable for everybody to use. But I do think if you look at the OpenAI models or the Anthropic models, they are starting to specialize, become really good in certain areas, even though they serve everything. So what the founders are doing is saying, hey, we want to be able to build our technology solutions in a way that we can use these models where they're good. And we want to be able to swap in and out of these models as and when it makes sense. Just like when they build companies, they can actually use different clouds where they're strong as well. So I think you're starting to see a little bit of the same behavior manifest here as well.
Do you think we're going to see a great degree of concentration in the tech industry? There's been a lot of talk right now that this AI trade, certainly in the public markets, is dominated by a small group of people. And even in the private markets, you look at the companies with the biggest valuations, it's a very small cohort. I guess, A, does it matter? And if so, is there the potential for maybe this to broaden out a little bit more?
I think first of all, we do run that risk because the ambition of some of these companies, the OpenAIs, the Anthropics, is like to try to do everything. So if they have the intelligence and they can do as much in software, they want to tackle as many problems as possible. I think that much concentration into a handful of companies maybe is not going to be that good. You do want to have a robust ecosystem. So to me, ideal is that you do build a handful of model companies that are inevitably going to become very large, but there is a vibrant startup ecosystem on top that does tackle these industries and tackle these business processes and create a next generation set of companies.
Before I let you go, I do have to ask you specifically about your own business. I mean, General Catalyst has been doing this a long time. You guys are, legends, if you will, in the business. There's also been a lot of talk as to whether the business model there should change. Have you ever thought, or have you ever given serious consideration to becoming public?
We're not contemplating going public, but I do think the industry has to evolve because the needs of the founders are changing. If you think about the kinds of problems we're taking on, they touch policy. They need much more differentiated set of capital solutions. You need to think about distribution and access to markets in a different way. So we have to do better in having a differentiated proposition for our founders, and that is a place that we're very focused on, continuing to redefine the founder value proposition.
I mean, we've seen a couple of VC firms actually seek out, actual financial certifications, even bank charters. Is that something you've considered?
No, we've not.
Okay. All right, Hemant, I really appreciate it.
Yeah, thanks for having me.
Hemant Taneja is the CEO over at General Catalyst, and he's got a new book out called Transformation Principles, How to Create Enduring Change. All right, let's get a quick check here on what's moving in the after-hours trade. You take a look at KB Home and Lennar, the home builders, not doing a whole lot on the back of those earnings that we just got out of KB Home. Stitch Fix is your biggest gainer, at least amongst the small and mid-cap space here this afternoon, up about 10% on the back of its earnings. We'll be back in a moment. This is The Close on Bloomberg. U.S.-based IPOs, they're having their best month since 2021. Klarna, Netscope, those debuts helping drive September volume to almost $8 billion so far, and it's painting a picture of improving investor appetite for newly public companies. Our next guest tracks this space closely. Brianne Lynch is the head of market insight over at Equityzen, and she joins us right now. And Brianne, there are sort of two sides to this. Obviously, there's the actual IPO itself, what appetite there is for these companies once to actually come to market in the first place. And then what's the appetite once they actually start trading and investors and their willingness to embrace that. Let's start with the first here, because for a while, there was no IPO market. It just seemed like it had just completely seized up. That appears now to have opened up pretty dramatically. Do you expect that to continue?
We absolutely expect the IPO market to continue to see activity. What it took was a few successful IPOs, which we had in the spring, to really encourage this deep pipeline of private companies that have been waiting for a very long time to go public to really take that plunge. So when you look globally, there's over 1,200 unicorn companies valued at over 4.7 trillion. A lot of these companies have been private for 10, 15, 20 years. You see that in the profiles of recent IPOs, and they're ready to take that plunge into the public markets, and the market has seemed right for that.
And it's interesting you talk about the maturity of some of these private companies going public. I am curious as to what investors think is most important as far as the characteristics of these companies? Is it still that kind of growth at any cost? Show us that you can, double, triple revenue over whatever time frame, or is it more about margins and profitability?
Sure. What we've seen from this cohort of companies that have gone public successfully is that growth is the most important metric. So investors are looking for companies that are growing at 20, 30% plus. That's really been the driver for demand for IPOs. And profitability is kind of the blue chip standard, but it's not a requirement these days. That being said, the growth at all cost mindset where you could be burning, hundreds of millions of dollars or, have no path to profitability, we've seen that there's less appetite for that. So it is a bit of a delicate balance, but especially after the drought of IPOs we've had the past few years, there's just pent up demand for fast growing technology companies. It's driving more investors into the private markets to invest before they go public in many of these companies. And that's making its way into the public markets as well.
I am curious, when we talk about the sort of reasons why a company would go public, I mean, you mentioned the maturity, and anybody who looks at any of the lists out there that shows the valuations of some of these private, I mean, the word unicorn is almost just passé at this point. There's just so many of them. But I am curious as to why they need to go public. Given that you now have some degree of exit paths in the non-public markets for early investors, is there still a real case to be made for some of these companies to do that?
It's a great question, and it's kind of the core of why Equityzen's business exists. What we've seen over time is that there's actually 6 times as many unicorn companies, so companies valued at over $1 billion in the private markets versus in the public markets. And why? Because they don't need to go public unless they want to. If you are a top performer in the private markets, you have access to abundant capital. You don't need the public markets to access capital markets. And you can achieve liquidity through tender offers, through platforms like Equityzen. You have Stripe in the news. They're doing reportedly doing a tender at over $100 billion valuation. Databricks just raised $1 billion at over $100 billion valuation. So to your point, forget about the unicorns. It's really the centicorns even in the private markets. And these are companies that have no near-term plans to go public. So it's certainly changing the dynamics of the market.
What options do, I guess, just rank and file investors have to access that private space right now?
What we've done at Equityzen and what we see as a broader trend is this democratization of access to private market investments. VCs, institutions, they've been able to access this market for decades. Now accredited investors are able to access the private markets, and on platforms like Equityzen, they can invest as little as $5,000 in these companies before they go public. And we really see that because so much growth is happening in the private markets, this is becoming a more crucial part of an overall well-diversified portfolio. So if you're only investing in public markets, you're really missing out on that growth allocation, and it's certainly driving investor interest.
For some of the companies that have gone public this year, one interesting sort of trend that we've seen, I don't know if it's a trend, but we've seen a few big companies make sure that there is much more of a pre-IPO allocation to individual investors. In the old days, those of us who are old enough to remember, if you weren't a big institution and if you weren't a multi-millionaire client of those institutions, you weren't getting access to these IPOs at all on a pre-IPO basis. Why do you think you're seeing more companies embrace pre-IPO individual investor allocations?
I think it's really just because of the demand in the market. You have these brokerage platforms that are enabling individual investors to get a piece of the IPO. But I would argue, based on the data and what we see, participating in the IPO could pan out well if some of these stocks pop. But depending on how they trade, it could still be risky. Where we're seeing more of the opportunity is to get in even before that. And I think what you're seeing here is kind of this grassroots movement where it's the individual investor, the more demand that they can really speak to pushes the larger institutions to make moves into these markets and create more products and solutions that address those needs. So it's certainly something that's coming upstream.
When you look at some of the trading activity in the secondary market after these companies have gone public, I mean, you've had obviously some real success stories. CoreWeave, I think, has more than tripled since its IPO, and Figma, I think it's done pretty well as well, up about 100% or so. Are you seeing maybe a little bit more upside activity in the secondary market? Because in the past, you would have these companies go public. You would get a big pop on the first couple of days, and then there would just be the slump. I mean, there's always these famous stories about how bad of an investment Facebook and Amazon were in those first, few months and years. And of course, in hindsight, they were wonderful investments.
Sure. I mean, every company is going to have its own story. And yes, there's so much news and there's so much buzz about how a stock trades on that first day of trading. But really, that is the first page in the whole chapter, or, the whole second novel about their life as a public company. So investors, I would say, are better to be focused on what they think the long-term growth milestones are for these companies. To make your point about Facebook, if you just judged based on the first few days or months of trading, you could have missed out on a great investment opportunity. So yes, those early days matter, but I think investors need to be thinking longer term.
Brianne, really appreciate it. Brianne Lynch is the head of market insight over at Equityzen. A closer look at the IPO market, setting up for one of its best months and best quarters in several years. When we come back, we're going to set you up for what to watch over the next 24 hours. A lot going on. Stick with us. This is The Close on Bloomberg. All right, well, the president of Argentina has had a tough couple of weeks here since his party lost those provincial elections in Buenos Aires, but now a potential lifeline. The U.S. is planning to extend a $20 billion swap line to Argentina and is preparing to buy the company's foreign bonds, a move that would provide financial support to President Javier Milei. Joining us right now from our Buenos Aires bureau is our bureau chief, Patrick Gillespie, to talk a little bit more about this. The market seems to like it. We're seeing third straight day of strengthening here in the peso. In fact, strongest three-day run that we've seen for the peso in quite some time. Kind of explain the contours of what we know, Patrick, about this potential deal.
Well, Romain, what we're seeing is what Secretary Besson this morning called a bridge for Javier Milei's party to get to Argentina's crucial midterm elections on October 26th. As you mentioned, the secretary is offering a $20 billion swap line that they're currently negotiating. He's also offered to possibly buy Argentina's bonds that are traded on global markets, and separately another loan as well. It's important to remind folks out there that all of this support from the United States comes on top of the fact that Trump approved a $20 billion agreement between Argentina and the International Monetary Fund just in April. So there's a lot of concern that the IMF agreement wasn't enough for Argentina to stabilize the situation, and that Milei needs even more financial support from the U.S. just to get for the next 4 weeks, as a currency sell-off has picked up the speed in the last few weeks.
For those investors who aren't familiar with Argentina politics, just explain this October 26th midterm election, and more importantly, if he does manage to actually win, or it comes out in his favor of his party, does that change materially the situation that he's in?
Well, Romain, I think what's been disappointing for at least foreign investors recently is a sense that a landslide victory for Milei in the October midterms seems out of reach at the moment. His party lost a crucial election about a few weeks ago. It's really ignited this market sell-off, in a sense that he doesn't have the political support in place to turn things around and implement the market-friendly reforms that investors are looking for on labor and pension reform. In these midterm elections, voters are going to be trying to renew about half of the seats throughout Congress. So it really could be a game changer for Milei if he performs well. But the reality is the economic recovery has stagnated. Milei's top advisor and his sister Karina Milei is facing bribery allegations, which she's denied. And there's a sense that the government's political strategy has gone off the rails. So this help from the government could be a financial bridge, but it doesn't change the root problem of Milei, which is a lack of governability in the coming weeks.
All right, Patrick Gillespie, our bureau chief down in Buenos Aires, and of course we are looking ahead to that election now, almost 2 years into the Milei administration, and a potential lifeline, a bridge, if you will, from the U.S. government. All right, let's set you up for what to watch over the next 24 hours. That includes more earnings out of names like Accenture, names like CarMax, and names like Costco. We're going to get economic data as well, including wholesale inventories here in the U.S., an update on GDP, durable goods, as well as those weekly numbers on initial jobless claims, and an update on existing home sales, which comes just 24 hours after that blowout number on new home sales. A lot of Fed speak tomorrow out of Gillespie, Williams, Barr, and Daly. We'll have full coverage of that and continued coverage of everything going on at the UN General Assembly.